Everyone, and big congratulations to the team, the Wealthy Nivesh team for completion for the EUM of 150 crores. I know after equity debt is not very interesting, but I'll try to talk about it in a little more, try to make it more interesting. I've been given a topic of talking about the outlook of the debt market. Before that, I would like to highlight, I just ask one question to the audience. What percentage of your portfolio is equity? That I would want to just with a more than 50% and less than 50%. Can we have a raise of hands? More than 50%? So I saw 7, 8 hands here. So I believe this means my understanding without my interaction with people who are around, majority of the people, there will be higher allocation to debt. The higher allocation to debt could be to the conventional debt products, which is fixed deposit, post office savings, and other senior citizen schemes, or whatever schemes is applicable. And or PF, Provident Fund, which is, if you are a salaried employee, then a good percentage goes to PF. So a higher percentage always of our investment goes to debt, and a lesser amount goes to equity, which should change. I personally think equity allocation, at least at the beginning of your career, should be higher than the debt. But debt is a good percentage of our portfolio, and it is we are more invested in the conventional products. I will try to bring it out a case where debt should be higher as a product, and we should move to mutual fund and less to the conventional debt products. I'll try to make a case out of that. Before I make that case out of that, I'll try to just present the presentation which we had worked on, more to tell you how interest rates in India or worldwide are dependent on few things, few macro things, which is one of them is inflation. Inflation is the most important factor based on which central banks raise or reduce the inflation and growth. So they try to balance inflation and growth. In India, India has always been a high inflation economy, the economy where inflation was always high. So hence interest rates were very high. But if you look at pre-pandemic, we went to 2015 to 20, we went to a scenario where Reserve Bank was given a mandate of controlling inflation and bringing inflation in the range of 4 to 6. And that happened. And once that happened, right now, RBI, Reserve Bank of India, targets inflation to be within the range of 4 to 6%. We have moved out of I remember as a child, when I was growing up, even our NSC used to give us returns of 18%. Sorry, 12%, 13%. And your other assets used to give 17, 18%. But even in NSC, a government security and government investment in risk-free returns used to be around 12%. Government securities were in the range of 11 and 12%. But now we are in an environment where interest rates will remain in the current range of 6 to 7% or 6 to 8%, one would say. On the higher side, if we are seeing inflation going up, that would be about to happen. How is the inflation playing out? What is the current inflation environment? Current inflation environment is such that India is in a very good scenario from if we were the only country to look at. Our macros was the only thing which Reserve Bank would have been looking at, then we have started cutting rates earlier than later. But we are not only the country, we are in an environment, we are in an open economy, we have to look at international environment. That's why we are where we are right now. The Reserve Bank of India has forecasted that for FY24, we will close inflation at around 5.3%. Why? And that is a big positive environment. Similarly, growth, we are in a good scenario. Though internationally, if we see, things are very different. India will have a growth at around 6%. Post-pandemic, we saw a very good growth. Now the growth would be, but 6 is not the target. Reserve Bank would want to target higher growth rates, and hence the general expectation in market is that we will see gradually, we will see our Reserve Bank of India would want to cut rates, but the rate hike cycle could be very shallow, of 25 to 50 basis point over in 2024 sometime, depending on how US markets pan out. Please. Another positive part of it is fiscal deficit. Fiscal deficit, the combined fiscal deficit of state and center has come down to 7%, has come down to 8.6% for the FY24 and is expected to come down further. And what is more important is the quality of fiscal deficit has come down, has improved quite a bit. Why? Because the revenue collections have improved, GST collections have improved. GST has brought in a much larger revenue. So fiscal deficit has improved broadly. So this 8.6% fiscal deficit may look a high number, but the kind of capital expenditure which governments are doing, that will bring in more and more growth, and hence what we say is the quality of the fiscal deficit is much better. CAD also is under control. Next slide. Another more important thing from interest rates point of view is the liquidity scenario in the system, which most of us don't understand outside the market. But from the banking industry perspective, liquidity is a very important factor. For various reasons, liquidity comes and goes down. Currently, liquidity is in a more of a balanced scenario. Reserve Bank of India, the 2,000 rupees note, which has come, removal of this, has improved liquidity by around 1 lakh crore in this last 1.5 months itself. We were at 2 lakh crore core liquidity in March end, which has increased to around 3 lakh crore right now, in spite of liquidity going out due to CRR movement and due to LTRO changes. So broadly, liquidity is, and RBI has assured the markets that liquidity will remain good, and they will provide the kind of liquidity that needs to be provided. Adequate liquidity will be provided. So in all this environment, what are we looking at? We are looking at a shallow rate cut cycle in 2024. If you ask me, 1 month back, we were saying it could happen in 2023 itself, December 23. But again, due to US decisions that they may give to another 50 basis Fed hike may come in, has pushed this thing to 2024. So that's a broad idea. So now all this thing, I understand as a lay investor, as an individual investor, we don't understand or don't want to get into the intricacies. Actually, we don't need to get into the intricacies. Debt products, please change the slide. Please change the slide. Next. Yeah. Debt products. Each of the debt products which are different types. These are more broadly the type of debt products that mutual funds can launch. So we have various, sorry, can I have a mic? So each of these debt products, if you look at, they have a time horizon. You know, in any kind of interest rate environment, whatever may be the interest rate environment, whether it's going down, going up, each of these products, if we choose, depending on our investment horizon, that is the right time to invest when you have the money. That is the beauty of these products. Liquid fund, overnight fund, naturally, these are one-day investments, very short-term, you can invest at any point of time. More of parking of money which would be lying in your savings bank account would be earning 3% broadly. So that is the fund which one should look at, liquid fund. Then we have three ultra short-term products, money market, ultra low duration. In any kind of interest rate environment, if you are investing for a 3 months to 9 month time horizon, if you have money lying in your bank account, which you think you may need in a very short period, your emergency fund or any kind of money which you think you want to deploy later, any of these three products can be chosen from the for investment purposes at any interest rate scenario. You don't need to know what is the interest rate scenario or how the interest rates will go up. Or if you are invested in these products 3 to 6 month period, at any point of time, one, these products provide you liquidity at any time. Like fixed deposit, if you book for a 6 month period, the liquidity comes after 6 months. But for these products, liquidity is an overnight liquidity available. So at any point of time, these are products which can be used for STP purposes. For just for STP purposes, you can just use them, or you can use for parking your short-term surpluses. Then if you have money, which we deploy generally in fixed deposits for 1 to 3 year period, all these intermediate products, these are intermediate duration products which run a duration of 1 year to 3 year. Most of these products in the market would run a duration of 1 to 3 year product. And if you are investing for 1 to 3 year period, you can invest in any interest rate scenario. And I'll give you some statistics in my next slide, which shows that in any kind of interest rate, these products beat your FD returns. Why do they do? I will come to this later. Why do they beat? Because the duration is 1 to 3 years, so the interest rate risk is that. So if you remain invested for 2 years, all your interest rate risk is diluted. Most of the returns that come from carry. So hence, if you match your investment horizon to the right product of in the debt market, these products you can invest in at any point of time, and what additional benefit that these products offer. I know in March 23, what happened was taxation was removed. The 3-year taxation benefit, indexation benefit has gone. So everyone says, because indexation benefit has gone, this is not no more debt product is better, it's better to be in FDs. Everyone would say that, but it's not true. Why I'll still make a case for a debt product? The case for being in a debt product is your taxation, incidence of taxation arrives only when you redeem. Normally, if I roll over my FDs, I don't mature them most of the time. If you go and see your portfolios of fixed deposit, 8 out of 10 times you would have rolled over. And if you need, then you go and get a premature FD. But otherwise, we roll over the FDs. If I'm rolling over the FD, I'm paying quarterly interest, quarterly taxation every quarter. Whatever may be the case, I have to pay quarterly taxation. TDS is being deducted. And annual taxation anyways when we are filing our returns. So, but these products, any of these products you are invested in, you can remain invested for 10 years if you don't need the money, and your tax incidence arises only when you redeem. That's a big benefit. De facto, it may so happen that you have not redeemed for years only. And that's the benefit of these products. So that's the case for debt mutual fund. Why one should invest in a debt mutual fund than in a fixed deposit. Taxation is a very important thing. It was a big benefit which we used to get. But please remember, Nirmala madam has made one statement very clear. Currently we are taxed on equity also 10%. Taxation will go from all investment revenue. That is the roadmap which government has given. Insurance it has gone out of. Debt market it has gone out of. It will go out. I don't know how long it will stay in equity and in what fashion it will stay if it stays. I'm not saying it will go off, it may stay, but how long and how, because PF also they have bought it under taxation if it's a larger amount. So I don't know about equity. So broadly about that, similarly, these are products, income, yield, dynamic, strategic, these are long duration products. Here interest rate risk is higher, so hence the time horizon should be higher. So I would generally say I've written here beyond 2 years, but one should have a higher time horizon of 3 years or 5 years to remain invested. So this could be an debt allocation, core debt allocation, but these products are very good products to replace any FD of 18 months to 2-year FD, because most of the FDs are done for that maturity profile. Other than that, credit risk fund, where the credit is higher, so the carry of those products is higher. So hence, they give you, the duration is similar to a short-term fund. but they give you a higher carry and may give you some additional returns over these funds depending on the credit profile of that fund. Beyond that, we used to have fixed maturity plans, which were the favorites of the market, but today they are out of flavor for various reasons. We have target maturity ETFs and index funds. Again, I will still say these products now with taxation benefit going and all, open-ended intermediate duration, short duration products are a better investment avenue than these products, because here also there is a terminal maturity. You have to redeem on a particular day. So it's best to be in an open-ended fund where you can continuously remain invested. That's the broad idea. Please next. Yeah, here so as I have highlighted, there are two types of risk which any debt fund has. We are market related for returns. We cannot assure you any performance that I'll give you 8% return or a 7% return. We don't have the ability to do that. If someone is doing it for you, it is just an indicative thing based on the gross yield and the interest rate scenario and his assessment of interest rate scenario. We cannot promise returns. Yes, we can tell you my current gross yield of my portfolio is this. Current interest rate scenario tells me this. This is the duration of that portfolio. Hence, we think this product can give you anything between 7.5 to 8.5, 7.5 to 8, 7 to 8, depending on the gross yield and other assessments of the interest rate scenario. Now, we did one exercise internally to see whether we can outperform a fixed deposit or not. Now, we took three types of products: conservative, intermediate, and aggressive. So, conservative is basically that low duration category which we were talking about, where their 6-month performance we assessed out of 134 plus 33. 134 times out of 167 odd, 167 odd times, 1.86% higher return than any FD at that point of time. 6 months back, when we did this exercise in March actually, 6 months back, if I would have booked an FD, these funds would have given 1.86% higher return. This is not my fund only, this is across industry. 1.87 means around 2% higher returns we are able to deliver over a 6-month period, which is not a small amount. And 33 times we have underperformed. And this is not a small period, 2010 to 2023. This is run on a data of 2010 to 2023. Yes, because we are market related, there will be underperformance, but that is much lesser than the, if you see at this thing. So similarly, for intermediate duration, which is basically the short-term funds, we run this exercise 107 times in the number of months, because each month we rolling returns we are taken. 107 months we saw 1.66% average higher returns. So what this table is telling you, that fixed deposit is a good product, a sure return product. I have no questions about it. It is the simplest product, which is the logo of them, simplicity. Yes, but simplicity is there in FD. It's very simple to understand, and we have grown up on FDs. But if you are looking at equity as a product, debt, mutual funds are a great investments if one looks at it over a longer period of time. Here also, you have to, you may have one bad experience because of your first timing of investment. But if you are regularly investing, instead of doing a recurring FD, invest in a low duration fund. Make a recurring deposit with low duration fund, or a short duration fund. So it's another product I will just mention in this, as part of my last thing. We have a Nivesh Lakshya fund. This is only for us. Nippon India Mutual Fund has one product called Nivesh Lakshya fund. We position it as a replacement or a parallel to a EPF. The Nivesh Lakshya funds invest in 2040 to 45 GSEC, which is 20 year around. 20 year from today, around 20 year assets GSEC, Government Securities, zero credit risk. It's a very good product. Current carry of that product will be around 730, 740, depending on the interest rate environment. Whatever the rate is, the carry moves accordingly. It is a very good product. If we have done one analysis on that product also, because it's a government securities, there's a semi-annual coupon that comes. It is not the timing of investment that is important in that product. Because most of 70% of the cash flows are half-yearly investment. So actually an auto SIP is happening. So the whole cash flow which you get at the end of the period, it is after every 6 months you get some cash flow. So it's not the date of investment which is important, it is the average period. So if you want to invest, other than your EPF money somewhere, that's a very good product one can look at. That's the only product which is a little different from the industry, and not many in the industry have a similar product. Thank you.